afternoon, everybody. It's my pleasure to welcome you to our Sundays at 2 once again. And want to remind you that next Sunday will be our last program of the season, when Richmond Yanni will be talking about his work in Afghanistan. He was there with the USAID. And now I would like to have our committee member, Ernie Monshine, will introduce our today's speaker.
Thank you, Gloria. Good afternoon, everyone. I'd like to welcome you to today's Sunday at 2 presentation, Focus on Growth, Virginia, and the Northern Neck 2020. As you know, there's a lot happening in the news today, not only on the coronavirus threat, but also on the stock market and the economy. Today's session is about the economy, but with a focus on where we live in Virginia, and Eastern Virginia in particular. How is the local economy performing, and where is it headed? To guide us in this examination is our speaker, Sonya Waddell. Sonya joins us from the Federal Reserve Bank of Richmond, where she serves as Vice President and Economist, Regional and Community Analysis. Sonya joined the Federal Reserve Bank of Richmond's Research Department in January 2008. She currently has responsibility for the regional and community development research areas within the department, including setting strategic direction for various data products, surveys, and other regional and local analysis. In addition, she directs the incorporation of regional information into monetary policy preparation for the Richmond Fed. Her work involves analyzing economic trends, writing for a variety of publications, and presenting on regional and national economic conditions. Prior to joining the Richmond Fed, she worked as an economist in the Virginia Department of Planning and Budget and at ICF International in Washington, D.C. She received a BA from Williams College in 2001 and an MS in Applied Economics from the University of Wisconsin-Madison in 2006. Please welcome Sonya to Sundays at 2.
Thank you, Arnie. I think this is on, right? Everybody can hear me? Okay. So I prepared some things to talk about today, and then went to lunch with a few people and realized that everything I prepared was the wrong thing. So let me just please ask you to feel free to go ahead and ask questions. I'm going to start with a discussion, a short discussion, a level set sort of the national.
The mic's not working.
Going in and out. Okay, maybe I can just hold it in one hand. How's that? Is that better? Okay. If that happens again, just wave, especially in the back. Just did? Alright, well, maybe if I switch sides, but maybe I just need to hold it. I can do that.
No, I think what the receiver is.
Well, let's see. Okay. Yeah, actually, I think the mic itself. It's definitely on.
Probably the receiver.
It's definitely on. I can just take that one. That's fine.
Anybody here?
This makes me feel like I'm about to start a rock concert. This is good. I can hold it. Yeah, it's not a problem. I might start singing though. Can't make any promises. So I'm going to start, like I said, with a discussion of the national economy, level set, and then talk about Virginia. And then talk about the areas within Virginia, but I'm going to do that in a way that, so what I want to do is I want to talk a little bit specifically about the rural or small town of Virginia as compared to the larger metro area, and talk about some of the things that we've learned. Woven through all of this is going to be sort of understanding what we at the Federal Reserve Bank of Richmond do and why we do what we do. And I would please, like I said, encourage you to just ask questions at any time. And I have an eye on the clock, so if we start getting too close to the hour, then I might ask for to stop questions, or give you the option to keep asking questions, or I skip stuff at the end is also fine. But of course, although I'm happy to answer questions, any views that I express are mine and not the views of the Federal Reserve Bank of Richmond or the Federal Reserve System. My standing joke is that I'm considering getting that tattooed on my forehead. It might make things easier. So, U.S. economy as a whole, where are we? Economic growth by the numbers actually looks pretty good. GDP is growing as anticipated, and I have a slide on that. Labor markets are tight by whatever measure you use. And sentiment indices have steadied now. I don't think we've gotten one in the last 2 weeks. The Purchasing Managers Index did come out, and that's quite a bit lower. So we can talk about that. We can talk about, say, I don't know, hypothetically, the effect of a virus that might start in Wuhan, China. On the other hand, business investment actually has been soft. It's been soft for a couple of quarters. There are still reports of lingering uncertainty. Certainly the election is something that often weighs on people, and now we have this coronavirus. I think talking about the election now as a source of uncertainty perhaps is not what the key on people's mind. And then if you look at the Virginia economy, we've been growing as an economy, but we have been lagging the US, and that's been true since the end of this last recession in a way that it wasn't true prior to that. Okay, so let me start with the national economy. This is the broadest measure that we have of economic activity at the national level. It's gross domestic product. This is a chart of change, so it's percent change over the quarter, but it's seasonally adjusted. That's the blue bars, the dark blue. And then the light blue at the end is the range of expectations for GDP growth of the members of the Federal Open Market Committee. So the 19, well, it should be 19, I guess it's 17 now, people who make monetary policy. So it's 12 Reserve Bank presidents. We have 12 Reserve Banks, and all 12 presidents are on the FOMC. And then it should be 7 members of the Board of Governors. We have 5 now. But so it's those 17 people, their range of predictions for GDP growth. And you can see that it's around 2%. So I heard our Director of Research, Kartik Athreya, say the other day, I think he was speaking to a group and he said, somebody wakes you up in the middle of the night and asks you what GDP growth will be. If you say 2%, you're likely to be, about right. And that's where we are. Now, if you look sort of over the longer term, why 2%? It's not just that it seems like a good number. It's about productivity growth. It's about labor force participation. It's about population growth. It's about the key things that make the economy grow, right? So we were about 2% in the fourth quarter, and that was what is anticipated for the first quarter of this year. Again, without the effects. Most of the national economy that I'm going to be talking about right now was without whatever effects that we see in the coronavirus. And I'm happy to talk about that too. I'm guessing that is on people's minds. Some of those effects, even in the worst case, are going to be probably pretty short-lived, as in we will, whether it's 1 quarter or 2, we will make it up in the second or third quarter with manufacturing production. But some of them might actually be longer lasting if we think about some of the services or the travel that people decide not to engage in. Okay, so employment. So we added 225,000 jobs in January. Let me also say that in this GDP number, about two-thirds of this number is consumption expenditures. And consumers have been buying, right? So we have seen some pretty solid growth in consumer spending. Why? Well, in part because of this. So maybe mostly because of this. We added 225,000 jobs in January. Over the course of 2019, we added on average 176,000 jobs per month. We added, the year before that was actually over 220,000 jobs per month. All of these numbers are more than enough to keep up with growth in the working age population. We've had years of employment growth. So not surprisingly then, the unemployment rate has continued to fall at 3.6%. So we've been bouncing somewhere between 3.5% and 3.8 or 9% for months now. And that is the lowest rate that we've seen since the 60s. So in 1968-69, we were at 3.4%, and this is the lowest that we've seen since then. So all measures, actually, no matter what you ask about, if you have a background in looking at labor market measures, you can ask about them, and I can tell you that just about every measure of unemployment is at or near historic lows. We can talk about labor force participation if you want to. We can talk about the JOLTS report. We can talk about all of the measures of unemployment at or near historic lows, and all of the measures of employment show strength. In addition, so this is where I start to digress, and I have to pay attention to the clock. So as Ernie said, I have been in the Federal Reserve Bank of Richmond since 2008. I started 2 months before Bear Stearns collapsed. And in all of that time, I've been working with regional data and working with economic data. What I had not done before starting at the Federal Reserve Bank of Richmond was work with qualitative data at all, right? And one of the things that we do is we engage with businesses across the 5th Federal Reserve District, which is North Carolina, South Carolina, Virginia, most of West Virginia, DC, and Maryland. So we engage with businesses across that area to understand what's happening right now on the ground. Why do we do that? Well, for one thing, it is March 1st and we still only have fourth quarter GDP data, right? So for one thing, even national data is lagged. When we get to state data, now this is the worst time of year to talk about state employment data, and I'll tell you why. But we are super lagged on the state employment data. So regional data is even more lagged often than the national data is. Also, data can give you information, right? It can tell you what's happening, but it doesn't tell you why. So I can sit here and tell you that we've had 2 quarters of decline in business fixed investment in structures. Okay, very interesting, we can talk about that, but I can't really tell you why. I can dig into those numbers and find by industry. Maybe I can look by region, but understanding why we've seen that decline, that's where we use our businesses. And then in addition, we need the kind of current, so basically what we look at is the data that also we don't necessarily have in the numbers, right? So one thing is that a lot of the data is lagged, we don't have a lot of regional data, and the data doesn't provide the context. I'm saying all of this because usually as I talk, I tell stories, and I tell stories from the businesses that we talk to, and that comes out even more when I talk about our surveys. But this number, all of this data is consistent with everything that we hear. If you go into a room and you ask people how many have tried to hire in the last 6 months, and however many raised their hand, it rose from about half to about 3/4. Now it's almost the whole room that'll also say they had challenges hiring in the last 6 months in their last hire. Firms are reporting a lot of difficulty finding workers to fill the positions that they have. So anyway, all of this is consistent. Now, I don't think I put in anything about wages, and I'm not going to talk about that now, but I'm happy to talk about wage growth as well and what we've seen there. Again, so this is before the most recent news has come out, but you know, towards the end of 2018, middle to end of 2018, we saw some really, or middle, I should say, spring to middle of 2018, we saw some real strength in a lot of the reports that we were getting from firms. So this is a measure of consumer sentiment from the University of Michigan, and so you know, it's kind of a sense of how consumers are feeling, and it's a little hard to tell, it's a little volatile, but you can see it sort of kind of go up really 2017 and somewhat in 2018. Then you see this decline at the end of 2018 and as we started 2019, and that's consistent sort of across measures. This is one that the Duke University Fuqua School does of CFOs. And again, this one declined towards the end of 2018, and then, end of 2019, beginning of 2019, and then started to jump up again. I'm having a really hard time with years, I have to say. Like, I'm trying to remember what year what happened. I still feel like 1990 should be like 10 years ago. Anyway, this, I struggle, I'm like 2018, 2019, but regardless, we saw this decline in sort of expectations in 2018, and we saw some improvement throughout 2019. And in fact, most firms and these measures talk about kind of starting this year a little more optimistic. Okay, so this is great, right? But I can't tell you any more about this number but this. The numbers I can tell you more about are these. So the light blue line, this is an index of manufacturing activity. The light blue is actually done at the Federal Reserve Bank of Richmond. So every month we survey manufacturers and we survey service providers or retailers, both. We ask them, did things get better, worse, or stay the same across a number of measures? Employment, shipments, sales, revenues, every month. And the light blue line is the share of people who said that things got better minus the share who said that things got worse. It's also kind of, we did a 3-month moving average. So anything above 0 for the light blue line indicates expansion, anything below 0 indicates contraction. The dark blue line is a similar one done by the Institute for Supply Management for the entire US. So one thing to note, and for that they scale theirs by 50, so for them anything above 50 indicates expansion, below 50 indicates contraction. One thing to note is that the 5th district seems to follow the US pretty well. We both saw this, like I said, improvement in 2018 that sort of fell towards the end of 2018 and into 2019, and then increased again. Actually, when we were in the spring of 2018, in our measure, we had some of the most persistently high numbers in that manufacturing index that we have ever seen. And it's however long ago 1993 was, that's the history of this series. And so what is that, like, it's like 25 years, right? Yeah, like 27 years. Okay, so for its 27-year history, we saw some of the most persistently high measures of that index, and then it started to fall. So February was actually a little bit down. Oh, then we started to improve again. So like flatten out or improve a little bit in the beginning of this year. February was a little down. So actually manufacturers were a little bit sort of more uncertain. One textile mill from North Carolina said they had an overall slow start to the year with all markets except for one was below normal, but orders were picking up in February. A furniture manufacturer from Virginia said tariffs have had a significant negative impact on our company. So one of the things that we were really hearing about from manufacturers in 2018 and 2019 was about tariffs. So and especially those with a global footprint. And then this one went on to say the coronavirus outbreak in China has also had an undetermined to date but clearly negative impact for the sake of our company and millions of people in China and other countries. We did have a fabricated metal manufacturer from Virginia said, I like this quote, impeachment, coronavirus, just slow, you pick one. I was like, that's not the point of these surveys. You're supposed to tell me. Anyway, so again, still some comments about uncertainty, still some comments about tariffs, but we saw a little bit of improvement among manufacturers. Service providers did not decline as much. They're a little bit steadier than the manufacturers have been. Like a computer and an appliance store, so it seems to be moving along okay. I believe we're starting the year stronger than last year. Commercial real estate, it continues to be strong in most markets. Residential real estate also strong. People are with the most common comment we get in the service sector is challenges finding labor. And actually that's true in the manufacturing sector as well. Outside of tariffs, difficulty finding labor is the most common comment that we get there. So everything that I just said is consistent with Virginia. So we don't hear things in Virginia that are all that different from what we hear on the U.S. as a whole or from what we hear in the 5th District. And in fact, the 5th District itself represents the U.S. pretty well. So this is payroll employment in Virginia. So moving outside of the whole district and just into Virginia. Employment in Virginia, you can see, has been slower growth. So anything above zero is growth, right? Because this is year-over-year percent change. But it's been growing more slowly than the U.S. since the recession. Before the recession, we were generally growing faster than the U.S. So that 1.1% growth December to December translated into 45,000 jobs for the state. Now, why am I telling you that this is the worst possible time to talk about payroll employment at the state level? Actually, this is not the worst possible time. I think March 10th is probably the worst possible time because we get revisions. So we don't have January or February data for the states now. I guess February, fine. February ended yesterday, but January we also don't have. In the middle of March, we get not only the January data, but then we get the entire past history of the data revised. So they benchmark that data. And at the state level, it can change, right? So I don't think that year-over-year percent change-wise, we're going to see a lot of change. The U.S. as a whole was revised down. Again, this doesn't really change what we look at with respect to trend, but we did add fewer jobs as a country last year than we had originally thought. So that'll kind of translate into Virginia as well. But there are reasons to believe, based on some withholding numbers, tax withholding numbers, and to think that we're actually going to see the Virginia numbers come up a little, but maybe not quite to where the U.S. has been in terms of growth. So we'll see. So that's I think it's March 11th or 12th or something that those numbers come out. So we have January numbers for the U.S., but for comparison purposes, I'm leaving December at the U.S. So we did have that little bump, in 2015 and 2016, and I can tell you what that was. That was professional and business services. So in Virginia, this is the share of employment in the state by industry. So, for example, this is non-farm and it's civilian. Important in Virginia, right? Civilian non-farm. So 17.9% of employment in Virginia in December of 2019 was in government. And then 15% of U.S. employment was in government. I am sure that every single person in this room is shocked to hear that Virginia has a higher share of government employment than any other state. Shocked. The other thing Virginia has, though, is we are consistently either number 1 or number 2 receiver of contract dollars. And we vie with California for the number 1 or number 2 spot. And their economy is like 4.5 times ours. So as a share of economic activity in the state, those contract dollars are a big deal. Where do most of those go? Into professional business services, which is 18.7% of employment in Virginia. Now there's a lot of other stuff in there, like most information technology. That information, 1.6%, that's not information technology. That's like print media. It's been declining for years. Like publications and that is declining across the U.S. and Virginia and all of our states. But this professional business services is big. So you can often say, so goes professional business services, so goes Virginia. And that has not been growing at the same rate, as it has in the U.S. We have seen consistently lower growth in professional business services employment compared to the U.S. Now, if you look at the recession of the early 90s, you look at the recession of the early 2000s, you look at the first 3 years after recession, and so for us after this recession, that's before the sequestration, right? Or maybe it's like right before. Yeah, the sequester was 2011, 2012, 2013. So if you look at like 2009 to 2012, so you take those 3 recessions, you take the 3 years after the recession, we never saw professional business services grow as an industry in the state like we did after this recession, like we did in the early 90s and early 2000s. That growth rate was about half. So this sector never pulled us out of this recession the way that it pulled us out of past recessions. But it's really important to look at like this. This is the chart we just looked at. So this is industry structure. To look at this before we look at year-over-year growth, right? Because like that information sector, that's 2.5% decline. That seems like a lot, but that's actually just about 1,600 jobs. While the professional business services, that 1.3% is about 10,000 jobs for the state because it's such a big share. And then natural resources and mining, added about 400 jobs for the state. The other thing that this chart, so one thing is that you can't, this doesn't show shares, it doesn't show number of jobs added, right? It's percent growth. But the other thing is that it masks differences within a sector, within a super sector. So I did a presentation once and this poor woman has no idea, but I don't even know her name, so I guess it's okay. She has no idea I use her as an example. But I did a presentation in Southwest Virginia, South Side. It was like I think it was like Martinsville area. It was like South Side Virginia, not Southwest. And I presented something like this. And she was very, very upset that education and health services are together. She said, like, when you look at in our area, I can't believe the Fed would look at that as one sector. And it felt a little like, I don't know, what is the word? Is it churlish? I don't know. To say that, like, well, that's BLS data. It's not Fed data. It's the Bureau of Labor Statistics. But we can look at this, obviously, much more disaggregated. I mean, my answer to her was, yes, let's talk about what it looks like within that sector. But if I put all of that on one slide, you would not be able to read it. So we talked about that. But, like, you look at trade, transportation, and utilities. Very important sector, right? So that's 16.6% of employment in Virginia, and we saw that 0.6% decline. That is not in all across, right? So we did lose 300 jobs in wholesale, but that was like a really small percent decline, 0.3%, and it's not a trend. That one's been sort of bouncing around zero growth, plus or minus. 5,000 jobs lost in retail. That was negative 1.2%, and we've seen a steady decline in retail employment for a couple of years now. Not shocking, right? On the other hand, we had 1,400 jobs that were gained over the year in transportation, warehousing, and utilities, right? So we've had steady growth there. So these super sectors also mask differences within the sector. Yes?
When you say government as a sector,
Yes.
do you mean state of Virginia employed, or do you mean employed by a government so that it would include U.S. government employees who live in Virginia?
Yes, the second one. Who work in Virginia. Not necessarily live in Virginia, but work in Virginia. Yeah.
What about education?
So, well, I'm gonna,
Because that's,
yes. So let me piggyback on, yes. So first, government includes state and local and federal, and state and local makes up the bulk of that, just like it does in every single state. School teachers, public school teachers are in government. For the most part, there are some state differences, so it's categorized, but for the most part, let's call it that they're in government. But private, like any private institution, those people working there would be in education and health services. Yeah. Okay, so this is my very favorite chart that everybody else hates, but I'm the presenter and so I get to put it in. It's indexed. What this is employment. Also, I have like 2 colorblind people in my department. I don't know if that's a lot as a share, like, I don't know if that's consistent with the population, but they really hate this chart. So this is employment indexed to 100 in December of 2007 for each industry, right? Okay, so these are all the industries. To the extent that they are back then above this horizontal line, they've regained the losses of the recession. Okay, so I'm going to point out 2 things here. One is, if you can look at this total, and then you can look at this professional business services, red, you can see, so goes professional business services, so goes total. Those really do move together quite a bit. Actually, maybe I'll point out 3 things. You can also see that this education health services does not exhibit the same sort of cyclical behavior that most other industries do. It's interesting. But the other thing is, over the course of the recession, we had like 38,000 jobs in the state that were lost in the goods producing sectors, which I'm calling manufacturing, mining and logging, and construction. Where's construction here? None of those lines are back above the horizontal line, right? So now, of course, they're all different, right? So mining and logging, well, that went back above. That sort of varies with energy prices. Construction peaked in 2005 and then came down. Manufacturing has seen sort of a secular decline in employment since the late 80s or early 90s. So they show different trends, but nonetheless, most of those jobs have not come back. And that is an important driver of growth if you look at the different parts of Virginia, and you look at who's growing and who isn't, or across states too. Like we compare ourselves to North Carolina, or maybe at the Thoroughsworth Bank of Richmond we just compare Virginia to North Carolina because we cover both states. They're side by side, and one of them has been growing really strongly and one of them has not, right? North Carolina has seen a lot of growth. And a lot of people, might think, oh, well, that's in manufacturing. I think the manufacturing plants coming in. Now, South Carolina has actually grown in manufacturing and service sector stuff. But North Carolina, most of that growth has been in the service sector, and a lot of it has been in professional business services. Okay, so I can talk more about that, but I'm gonna, in the interest of time, keep going. So this is just to show sort of where the metro areas are and where the micro areas are. Now, so one thing is that you can see that most of Virginia is covered in either a metro or a micro area. If you look at the Northern Virginia is like 37% of employment in the state. Hampton Roads is about 20%. Richmond's about 17%. That's in the MSAs. So if you look at those 3 metro areas, you have most of the employment in the state. So it's worth sort of keeping that in mind. And then I want to talk about these white areas too, right? And these the micro areas or the smaller metro areas. But so before, it's nice to look at this map before we look at this. So this is year-over-year employment growth by metro area. So again, Winchester has been pretty fast growing metro area for years. It's picked up a little bit, but it's also a really small share of employment, right? So that 2.2% growth is around 1,400 jobs for the state. On the other hand, for Northern Virginia, that 1.3% growth means over 20,000 jobs for the state over the course of the year. Richmond was 12,000 jobs for the state over the year. Virginia Beach has picked up a little bit, right? So Virginia Beach has generally been growing more slowly than other metro areas in the state. I guess it still is, but it's actually picked up. It was kind of hovering around 0 for a while. Roanoke, that's a recent phenomenon, actually, as you can see in this chart. So this is year-over-year percent change. So if you look up here, this is exactly what we just looked at in that chart. This is the 10-year growth, right? So this is the extent to which a metro area has actually sustained that growth. To the extent they're in a top right area, they have not only grown recently, but they have been growing for years. And Roanoke is not there, right? So Roanoke has seen some recent pickup in growth, but has not been growing as strongly as, say, a Winchester or even a Richmond or a Northern Virginia. And then the size of the bubble is by share of employment in the state, as we talked about. Now, yes.
You mentioned 20% Hampton Roads and 37% Northern.
Yeah.
Where's Hampton Roads?
Hampton Roads is here.
So your two numbers were 37% and 6%.
Yeah.
You said that's, it says total employment, but you said that's growth over the past 10 years?
This is, yes, so this is year-over-year percent change here. So here's like the 1.2% of Northern Virginia or whatever, 2% of Richmond, and then this is growth over the last 10 years. The bubble size is total employment. So the bigger it is, the more employment there is in the place. Yeah.
Do you have that broken down to millennial growth? Because both Hampton and Richmond, and as well as DC, are high millennial growth versus other areas.
So let's see. We can't break this down by age, as far as I know. So this is employment that's submitted by the company. What we can do is look at employment by age, by where you live. That's the unemployment rate. And we can do that by metro area. I haven't. And what I'm wondering is if we can even get that at the interval that we would want to. Like, I'm wondering if that's actually census data that then we would have like every 3 years, or every year, but it's sort of got a high margin of error. Yeah. So, but this one by employer, I don't think that we can do that. There are other ways. There are other ways to get at sort of employment growth in an area by age. And I'm thinking so what this data is like. Any firm that is subject to the unemployment insurance claims program has to submit to the Virginia Employment Commission their total employment, right? So that's the payroll employment. Then the Bureau of Labor Statistics takes it from all the employment commissions and pulls it together. That we don't have by age, as far as I know. Maybe they do, but maybe the VEC does. But I don't think that an employer would submit the age of the person working. I think they just submit numbers. But the unemployment rate comes from a survey of households across the U.S. And then you ask somebody, are you working? Are you not working? You know, it's a series of questions. And for that, they do ask like age. So that might be one way to get it. But I think there are other data sources as well. But this one we don't. Yeah.
Just to piggyback on that, this is employment numbers. This has nothing to do with wage.
Correct.
Okay, just want to, because that becomes an important factor.
Not only is it employment numbers, it's also just employment numbers by companies that as a sample. Okay, but let's assume that the sample is good. So a sample of companies that submit to the Employment Commission. So it's not going to include Uber drivers, for example. The people who are employed in the gig economy are not included in this. So it's missing, Yeah. Or it doesn't include, actually this would include part-time as well. So if you submit that you have somebody working on your payrolls, they would be included in this. The way that we get at all of that, well, not the gig economy, but the way that we would get it like part-time or underemployed is pretty much through the household survey, through the other survey. Yes?
What if you try to integrate the data also with like cost of living and increased wages and kind of correlate it to see which areas are, like where the people actually be, are they getting a little richer or poorer?
Mm-hmm.
That sort of thing.
Yep, we can do that. We can do that. Now, the more, if you say by where, you mean where by industry, we can do that.
I'd
But
like to
gee-
actually be able to drill down the industry in a specific IC field if possible, but then,
Yeah.
also larger data might be used for
Yeah, I'm not sure how deeply we can go here, but the QCW, so there's actually there's other data that we can use to get at that. Geographically, it's a little harder. When you get into this, it's actually easier to look at drill down by industry for a large area than it is to drill down into small area or even to get small area data, because the smaller the area gets, the less data is available. But yeah, that is something that we could do. It's just I don't do it here. Okay, so this is the unemployment rate. I mentioned that for the U.S. we're at the lowest unemployment rate for the 60s. Virginia, this 2.6% is certainly low, but we got down to 2.1% in 2000. So it's not the lowest we've seen in Virginia, but it's still low. And we have consistently, even though we've been growing less quickly, we have consistently had a lower unemployment rate than the U.S. We have a highly educated population. We have a pretty diverse industry base, and we also have that buffer of Northern Virginia. I mentioned I started in 2008, and pretty soon thereafter we had this, housing crisis. I don't know if you guys remember that. I'm kidding. I'm just kidding. But actually, if you talk to college students, they actually don't remember. Like, you have to start by talking about the financial crisis. When I say I started 2 months before Bear Stearns collapsed, in a group of 22-year-olds, they're like, what do you mean? What's that? They weren't listening to NPR, like watching CNBC like everybody else, watching that money market dip below 1. Anyway, so I completely lost my point. Oh yeah, so when I started and we had the mortgage crisis, right? We're looking at delinquencies, we're looking at foreclosures. The worst part of Virginia for delinquencies and foreclosures was Northern Virginia, right? That was the highest delinquency, highest foreclosure. Now you had Hampton Roads, right? Those beach houses, mostly second homes and stuff, certainly. But the worst was Northern Virginia. That still had the lowest unemployment rate, right, in the state. So this has pretty much looked like this. Just the colors the entire time. So this is unemployment rate by county. And the entire time the 12 years I've worked at the Fed, it's looked like this. But these numbers have changed, right? But you can see that unemployment, you have 2.6% at the state level, but it varies a lot within regions. And so when we think about growth, right, the two most natural ways to break it down is 1 by industry or 2 by geography. Like, how are people doing by geography? So, certainly, if you look at Southwest Virginia, other than Scott County there, but you look at Southwest Virginia, South Side of Virginia, it's some of the highest unemployment. Lancaster County, where we are, was 3.9% in December. But this is a super seasonal area. So actually what I find is that every single time, I have not spent a lot of time in this area, I confess. Every time I start to pull together a presentation on a new area, what I really find is what I don't know, right? So I looked at this series, and December through March has really high, December through March has high unemployment, and then you see it really fall, and then it rises again. Northumberland was 3.6% in December, but it'll be on the upswing until April. And I'm assuming that this is 2 things, and you all tell me if I'm wrong here. I'm assuming 1 is that you're on the water, and so it's seasonal, right? In the summer and in the fall you have higher employment, lower unemployment. And then I'm also assuming that it's because it's small, right? So we see that seasonality in some of the other counties in Virginia, but not as strong swings. And I assumed that was because you guys are small. Yes.
We have a lot of agriculture.
Agriculture. Okay. Yes.
I don't know if it's taken into account, but by the census data, we dropped about 7% of the population, which is primarily the middle ages, the 30 to 40 in this area. And how would that affect?
So actually, in some ways, that is actually easier to see here. So this is employment to population, because the problem with this number, this unemployment rate, is that what is it? It's the number of people who are not working and have looked for work in the last 4 weeks, divided by those people plus the employed. Because those people plus the employed are the labor force. But then what if you aren't working but have looked in the last 12 months, but not in the last 4 weeks? Okay, what if you're just discouraged? What if you just gave up looking, right? So these are all people that are out of the labor force. Now, we can break this down nationally for sure, but also in some cases by region, to understand why people, or who's out of the labor force, right? And we certainly can do it with less timely data. But if you want to sort of understand age dynamics, this one is just cleaner, right? So this is the number of people who are employed divided by the population. This is 16 years and older. Now the relative, like the colors of the map, doesn't change that much actually if you do 16 to 64 or 16 to 54. And this is something that we were doing because a lot of the more rural areas skew older. And of course, the older you are, the less likely you are to be participating in the labor force. But so this kind of helps to get at that a little bit. But I would say, okay. So actually, let me keep going, and then we'll circle back to that a little bit. Someone else here. Okay. Okay. So one of the things that we started looking at. All right. Let me put it this way. For years, we've known that employment and population are moving towards the largest metro areas, the larger metro areas, at the expense of not just the rural areas, but the smaller metro areas or cities, right? The smaller cities. We have been moving out of rural areas since the country was founded, right? So that has just been this long-term trend. But that we also are moving towards bigger metro areas. So we've known that. One of the things we started to try to understand a little bit better a couple of years ago, the beginning of last year, is why. So let me see, is that next? Okay, so what is this rural-urban, I don't know, divide? I mean, that's hard, right? Like, I don't like the word divide, because I don't think it's that clear. Okay, so you look at this, right? So this is employment, population growth, from 2011 to 2017. The solid lines are the rural, and the dotted lines are the urban. Okay, so rural and urban here are not rural and urban. So what we did was we took these codes that the USDA has, and they have 1 through 9, and they would call 1 through 3 urban and 4 through 9 rural, and we did 1 and 2 urban. What does this mean? Because obviously, how many people know what 2 is in the USDA code? I'm just kidding. But in this case, rural includes counties and metro areas like Charlottesville, like Blacksburg, Harrisonburg, Danville, and Martinsville. In fact, the only places in Virginia that are urban in this categorization are counties that are in Richmond, Virginia Beach, DC, Roanoke, Lynchburg, and Kingsport, Bristol. Right? So I wouldn't consider Blacksburg or Blacksburg and Charlottesville is weird, right? They're weird because of the students. Well, Harrisonburg a little bit too, but I don't know that I'd call Danville rural. Yeah, it's but it's a town, right? Surrounded by rural areas. Charlottesville, Blacksburg, and it actually gets even a little bit starker as you look across our district. In some states like South Carolina. But why did we do this? Well, we did it because small towns are suffering population loss too, and employment loss, or at least growth that's not as strong as what the larger urban areas are. And so we were trying to understand why that is. So that's true for job growth too, right? So this is year-over-year percent change in job growth. So when we talk about sort of these differences between rural and urban areas, this is what we're talking about. So why does the Fed care, right? So I thought I should spend a minute sort of talking about why we started looking at this. Okay, so one is we have 3.6%. We have the lowest unemployment rate since the 60s. We have a very tight labor market. One piece of the Fed's dual mandate is maximum employment. That does not mean, that's our mandate, right? We have a mandate for maximum employment, stable prices, and then moderate long-term interest rates. But when you hear about the dual mandate, it's maximum employment and stable prices. What is maximum employment? It's not 0% unemployment. It's the level of employment that's consistent with maximum sustainable economic growth. Well, how do you figure out what that is without understanding the labor markets that are underlying whatever that number is, right? So are we sort of, are we thinking about maximum employment in a way that, that represents sort of the way that the labor markets in the country are sort of interacting? I mean, the other thing is that, you know, do we have, what I really mean by that is, do we have areas or populations where we have, say, employment to population ratios that are quite a bit lower? So if you look at that employment, I think I have this number actually. Employment to population ratio, yeah. So in Virginia, this more urban employment to population ratio was 63%, I think that was 2018 number, versus 53.4%. This is 16 to 64, so it includes 54 to 64, 54 to 64, yeah, but not older than that. So that is a 10-point difference in employment to population ratio between the more urban and the more rural, right? So is there a way that we could add people into the labor force by understanding the challenges that rural areas are facing, and sort of finding a way to give people, and what is it, right? That's really important to know what it is, and I'm going to talk about that in a minute, but to give people the opportunity to participate in the labor market. So that's one. The other thing is that this tight labor market tends to help people on the fringes, right? So as you see if you see during a downturn, the people who are the most hit are the lower educated, are the lower income, are the people who are the hardest then to bring back into the labor market in an upturn, right? And so never waste a tight labor market, right? Like right now we are seeing wages go up more for entry-level workers than for anybody else. We are seeing minority populations, we are seeing rural areas, even we are seeing improvement in areas that are sort of sometimes the last to be brought back into an expansion. So we have an opportunity here. That's one. The other is that, so in the 1970s, the Congress passed the Community Reinvestment Act, which required banks, or I should say required regulators to examine banks based partly on their access to credit of low to moderate income communities. So they want to make sure that banks are lending throughout their footprint, and everybody has sort of the access to credit, right? So this is a very simple way to discuss the CRA. And if you read the newspaper, you hear a lot about the CRA right now, right? Because we're in the middle of this CRA modernization. As a part of that, as a part of requiring every reserve bank to have examination staff that goes to banks and looks at their lending to low to moderate income communities, they already had to do safety and soundness, right? But this is low to moderate income communities. Every reserve bank has to have an area that understands those communities, right? So we have a mandate actually to understand the economic conditions that are facing low to moderate income communities throughout the country, but for us throughout the 5th Federal Reserve District. And actually that's a piece that I took over. So we were talking earlier about sort of some changes and stuff that we've had. We've had a lot of changes in the last 2 years. And one of the things that I do now is I have responsibility not just for the people who do the regional economic analysis, but also for the people who are analyzing community development and economic activity and sort of demographics throughout the 5th Federal Reserve District. So that's the other way that we get at this. And then we just, right now we have a president who came in January of 2018 who has a real interest in engaging with the community. He wants to be out there, and he wants to be out there in those white counties as much as he wants to be out there in those blue counties. So yeah, if we want, the reason why I focused on metro areas is because it's a really large share of employment. So if you're looking at employment in Virginia and you want to look at trends, you have to look at those metro areas. But if we want to really understand what's happening in the state or in the district or in the U.S., we have to sort of look at what's happening throughout the state. Okay, so what have we learned then? And we're still learning. I mean, this is it. How do we learn? We learn by some reading, some data analysis, some engaging with communities, sending different people out to engage with different parts of different communities and try to learn what's happening there. So there are some themes that we developed. One is clearly education. Shocking, I know. But educational attainment is lower in rural areas. Now this is share of people with a bachelor's, right? This is one measure of educational attainment. And now I can talk about other measures that we look at as well. This is the simplest one too. And you can, like, we have areas of counties in Virginia where like over 75% of people who live there have a bachelor's. And then we have areas of Virginia where it's under 10%. In the US as a whole, 22% of rural areas have a bachelor's compared to 35% of urban areas. And in Virginia, it's about 21 versus 39. Now, why do we care then? Yes?
Isn't that a little bit of a chicken and the egg type of thing? You know, the fact that people actually have opportunities in those areas and therefore draw people in with a higher level of education.
Yep.
Therefore those people are there. You know, it's kind of like it's self-perpetuating, right?
Yeah, yeah. I sat there in a meeting with somebody who worked for the community college, not the president, but somebody who worked closely with the president and a firm. And the community college was saying, yeah, we educate these people. That's what our measure of success is, right? It is giving people the tools they need. Not just we educate them, they get a job, right? Our measure of success is, and this is like technical school, right? So it's not, but like, is the extent to which they get a job soon after leaving. And the firm said, well, I think your measure, it was economic developer. The economic developer in that region was like, no, we need them to stay here, right? Our measure of success is the share of people here who have some sort of degree, right? Absolutely. Absolutely. And this is the standard, sort of economist debate, right? It's not even a debate, actually. Most economists would advocate for people-based solutions, not place-based solutions. Why do we care about places? We care about the people in those places, right? So if you educate people, if you focus on education, and you focus on looking at a middle schooler and saying, hey, middle schooler, here are all the options that are available to you. We have a 50% graduation rate from our colleges, maybe 55 and 6. So 55% of people who enter a 4-year school graduate within 6 years. Right? Okay, so what about those 45% people? If we talk about student loans, if we want to have a conversation about sort of where people are after finishing school and what the opportunities are for them, we have to talk about that share of people that are graduating. Because if you look at this, there's a really good reason to go and get a bachelor's degree, right? So this is the median earnings over your lifetime by degree. And in the in Virginia, $40,000 difference between actually double, right? So getting a bachelor's degree doubles your median lifetime earnings compared to having just a high school degree. In addition, and I can make these slides available to you if you don't have them already, so I'm going to skip through these a little bit in the interest of time, but let's look at this. So when you have a bachelor's degree, your unemployment rate, your likelihood of being unemployed is much lower, even in a downturn, than it is with certainly less than high school, but even high school and some college, or high school and no college, right? So it's not even just that, in a given moment you're more likely to be employed, it's that over time your labor market outcomes are better. Yes?
So quick question, when you say college, is that broad definition including technical?
Sadly, no. I mean, yes. Yeah. Well, and the problem is that this particular data, if we break it down by earnings, it's some college or associates, those outcomes I'm willing to bet are rather different. Starting college and not finishing it is very different from getting a technical degree. Yeah, and so we have other ways. So the problem is that like community colleges, like even gathering data for community colleges, how they measure success is very difficult because they do so many things for so many different people. Maybe they take in high school students and they supplement sort of the high schools. Maybe they really focus on transferring, right? So some community colleges are focused on you do a year or two here and then you can transfer to a 4-year education. We're kind of bridging the gap between high school and a 4-year college. And some are really working with industry and saying, hey, let's design a program. Like I talked to a community college and they were like, we don't have the funding to use the technology that these firms have now. And the firm's like, well, they're working on 2-year-old technology. And by the time they educate somebody, that's gonna be 3-year-old technology, and we're trying to move to the next generation of, not, next generation isn't a generation, like a year, like a 2-year generation. You know, we're working on the next step, so they're not training the kids on the technology that we have today. And so there are firms that are working really closely with community colleges to do that. So that's absolutely true. That's absolutely true. And I always feel like, you know, I look at these numbers and I don't believe that it is a irrational decision for a parent to say, I want my kid to go to a 4-year school because of this. On the other hand, you have 45% of kids that are not graduating. So I have an 8-year-old. I have an 8-year-old and a 5-year-old. So when my 8-year-old was about 4, she saw my college reunion sticker on the refrigerator. And it's a purple cow, so she was all excited about it. And she was like, what is that? And I said, it's my reunion sticker. And she said, Mommy, am I going to college? And I was like, yeah, you're going to college. My grandmother, well, so I have one grandmother who had her first kid when she was 16 and got married at 15. But on the other side, my grandmother actually went to college during the Great Depression, right? So, you know, and she was educated. My parents got college degrees. My husband had, I was like, yeah, you're going to college. And then it was like, hang on a second, post-secondary education. I was like, you don't have to go to college, right? Like, you have to learn how to learn. You have to learn math. You have to do some technical stuff. But no, you don't actually have to go to a 4-year college. You have to do something after high school, though, post-secondary education. Anyway, then she's like 4 years old, right? So she's like, oh my God. Like, I'm walking away from this conversation. I don't even know why I engaged with that mother. Okay, so, and education also matters for regions. All right, so, yeah, so I mean, evidence suggests that everyone benefits from having more skilled workers around too. I mean, this is, again, like, I could actually talk for a really long time about this slide alone. This alone is an entire literature in economics. But again, in the interest of time, I don't want to do that. Here are some resources that are sort of that are interesting. That was developed. It was a collaboration between a couple of reserve banks, including ours, and it walks students through. Okay, if you want, this is the lifestyle that you want. These are the skills that you like. This is the kind of place you want to live in. This is what you need to think about in terms of education. So it is interesting. It's really great, actually. I'm certainly going to have my kids do it. Okay, so one is education. One is connecting people to jobs, right? So, okay, you can have all the education that you want in an area, but if there aren't jobs, people will leave.